I'm just going to talk a little bit about the resource market really sort of from here until year end. I mean, I'm expecting something positive and bullish for significantly longer than that, but I thought I would deal with the immediate future, let's say the next 3 or 4 months. Those of you that trade resource stocks and have any length of time already know, of course, that there is a fairly strong seasonal pattern to the juniors in particular. Generally speaking, especially in any year really in a bull market, the strongest seasonal period tends to be September through to January. That's partially a throwback to the good old days, if you will, when virtually all the projects being worked on were North American and, for that matter, Northern Canadian, and you essentially saw the bulk of the results and the bulk of the news flow from mid-September through to January as crews came back and stuff went into the lab. I mean, that's not really the case as much anymore. Obviously, the projects are a lot more international, but still, we seem to get that same seasonality. Part of the reason for that is the gold price, which also has its own seasonality most years, and I'll flip that in the next slide. One thing I do want to point out, and again, I'm sure most of you know this already, the exploration sector is having its busiest year in probably a decade, might even be more than a decade actually. And one thing I want to note, I think some of the presenters from the companies will probably mention this, but I wanted to remind people that unfortunately, fortunately, what happens in years like this, when you hit this time of year, the assay labs tend to get quite swamped. This is essentially a North American lab issue. I don't think this issue exists with either the European or the South American labs or the African ones for that matter. It's largely North American, and it's largely just because so much stuff comes out of the bush at the same time. I've had several guys tell me that their assay times have lengthened alarmingly, I think was the word one of them used. The bad news is that means the news flow starts a little bit later. I don't think it will impact the seasonality much. The good news is it probably means we see results from northern projects, well into January, I suspect, for a lot of them, because of essentially on top of that, the only other thing I could see derailing this in the next few months is something really nasty on Wall Street. I'm not really expecting that because another seasonality that's at play in the broader market is you do have fairly important election year cycles on Wall Street. Generally speaking, you don't see major bear markets around elections. You tend to see move up after elections, regardless of who wins. Doesn't matter whether it's Republican or Democrat. In both cases, you tend to get moves off of elections. The main thing that could potentially derail that is simply things getting too overheated. I'm actually pretty happy to see the pullback we've seen in the last few days on Wall Street. Wall Street was definitely starting to freak me out. Things were getting way, way, way too speculative. When you start seeing, Robinhood traders putting down $50 billion on short run option trades that are out of the money, it's not going to end well. And I think it's better that those guys all get a bit of a lesson now rather than later. But there is some potential that we'd see some kind of a mini crash just based on too much speculation on Wall Street and simply running out of buyers. If that's the case, those things tend to lead to a pullback for everybody. But I'd remind everyone, as I did many, many times in March and early April, that in that situation, I would expect to see gold maybe pull back slightly, but only very slightly, and probably move higher in that event. And that gold stocks, including juniors, would be the first thing to benefit coming out of it. And I think they would turn very quickly. So it's not something I'm that concerned about when it comes to resource stocks themselves. I'm just saying it's a possibility. One thing I want to point out here is that we also have a sort of an annual seasonality for gold. Now this chart is quite out of date, as you can see. The span of this chart is 2002, 2010, but I picked it intentionally because that period was the last sort of long-running bull market in gold. That it's probably most similar to the situation that we're in and entering now. what this chart shows you is the monthly price change from the previous month going through the year. As you can see, as you get into August here, I mean, that's a negative, meaning most August the price dropped, but then you see the price move higher, and you keep seeing this strengthening all the way really up until March. Anytime where it's positive, that means the price ended up being higher than the month before. So that seasonality, I expect we're going to see that hold again this time, and that's another reason why last Q4, early Q1 tends to be the best time of the year for these stocks. Gold itself, this is a much longer term chart going back for a year here. It's been consolidating since August, and again, that's fine. Frankly, my feelings about the gold and silver markets in mid-August were much the same as my feelings a week ago about Wall Street. It was starting to freak me out. I was actually happy to see it pull back a bit because it was definitely starting to go parabolic. Silver was parabolic. They both needed to chill out a bit. We're seeing that happen now. I'm not concerned about this. It's been staying well above its 50-day average. It's up again today. I think the consolidation is probably just about done. And honestly, if gold's sort of anywhere in this range, 1950, 1925 even, and above, I don't think it's going to be a drag on companies as they're putting out results and stuff. I think anything in this range is supportive. And I'm not concerned about the gold price. I'm expecting it to start moving higher again here fairly soon. Longer term view, this is gold stocks. This is a GDXJ, and this goes all the way back to 2010 when the index was, when this ETF was created. GDXJ, I'm just picking that because it's sort of closest to the stocks that I follow. Even GDXJ, the junior index isn't really a junior index. It's essentially small producers and late stage developers mainly. There really aren't many. There's only a handful of exploration stocks in it. But if you take a look at the pattern we see here, it's interesting to note that the percentage move that we've seen since March of this year is actually bigger than the percentage move that we saw in 2016, a year that I think most resource traders look back on fairly fondly. Percentage-wise, at least, this one was actually stronger. The other thing that's worth noting, and keep in mind, this is a semi-log chart, so we're way, way below the highs that this index saw in 2011, 2012, when gold was trading at essentially the same place. It's basically trading at about half or less of where it was back then. I think part of the reason for that is we haven't seen that much of the generalist money yet. It's just starting to come in now. I think there's a lot, and I mean a lot of generalist money to come. That's when you really see very large moves in these stocks. It's not that big a sector. When everybody on the street, and by that I mean Wall Street, decides you need to own these things, you're going to see some very large moves in a lot of these stocks. I wouldn't be surprised at all if we do see GDX and GDXJ hit or even exceed their 2011, 2012 numbers before this thing's over. And that obviously tells you, I think we got a long way to go still. As far as the current correction goes, those of you that get my newsletters, you realize that I very much focus on real interest rates. I consider them probably the most important determinant of the gold price and short-term gold price moves. To put it simply, when real yields, that is inflation-adjusted yields, are negative, that means there's essentially no carry for gold. That's always the knock that traditional investors have on gold, is that it doesn't have a yield. I do remind those people sometimes of Warren Buffett's saying, which is, I'd rather have return of capital than return on capital. And when markets are scary, it's nice to have something that's a bulwark against all the craziness in the rest of the market, which gold has been. But yields, and in particular negative yields, are a big factor, and they have been lately. If you look at this chart, this is a one-year chart of the 10-year Treasury yield. You can see this downtrend pretty much from the beginning of the year, and of course that downtrend was matched by an uptrend in gold. The pullback we saw in the last little while really comes down to this jump that we saw in the 10-year yields and all the way up the yield curve during August. That was largely just due to positive economic sentiment. Traders started getting getting more and more positive about equities. They were selling off bonds, which increases the yields. That kind of topped out and flattened out after FOMC Chair Powell's Jackson Hole speech. During that speech, he essentially, I mean, he didn't literally come out and say it, but he effectively came out and said, we're keeping rates at zero for the next 3 years, 5 years, God knows how long. Essentially they know they're painted into a corner, and they're apparently more concerned about the real economy than Wall Street is, because they're still being very defensive, putting lots of liquidity in. And obviously, if we do get some kind of consolidation or correction on Wall Street, that'll put downward pressure on yields. People move into the bond market, buying bonds drops the yields. They go more negative. That's part of the reason why you see gold turn first. But the important thing is the real interest rate. What I'm showing you here is a chart back to the start of 2020. This is the real 30-year yield. You can see it, again, it was dropping continuously. That was a positive for gold. And once we got into March, April, after the initial sort of bounce that rates got during the crash in March, this trend continued, and really since March seems to be negative and increasingly negative. There's been a couple little bounces, but these negative rates look like they're here to stay for quite a while. My only concern about the longevity of the negative rates is, the Fed and the market is making assumptions about inflation that I still think are probably a little optimistic. I don't personally have a problem with inflation. The Fed's basically saying they'd like to see more than 2%. I wouldn't mind seeing more than 2% either, because I think the gold price would go completely insane in that backdrop. I just don't really know how the Fed's going to engineer that, based on how things have gone the last 20 years. Increasing deflationary pressures have been essentially a constant thing for almost 30 years now. I don't know how the Fed's going to do it. I hope they pull it off, but I don't personally see how they're going to do it. I know that's what they want. The long-term game plan for the Fed and all central banks, none of them want to say this, but essentially they're talking about yield curve control. What they're hoping to do is generate inflation, basically keep yields as low as they can in the longer part of the curve. And in doing that, essentially what you're doing is inflating away some of the debt, the massive debts that all of these governments are carrying. This is essentially what happened after World War II. This is what the central banks did. It was, at that time, it was actually formal yield curve control. They let inflation run up to 3, 4, 5%. They kept rates about 1%. That helped the economy, of course, diversify and bounce back from the war effort, but it also helped them essentially inflate away the large debts that were built up during World War II. The debts are far larger now than they were at the end of World War II. So they've definitely got their work cut out for them. I just don't know how they're going to do it personally. But my game plan is basically following their game plan. I'm assuming we see negative real yields for a long time, which means we see a good gold market for a long time. Of course, those negative real yields and really, for once, really, I would say a less aggressive European Central Bank, which is unusual because they've been certainly more dovish than the Fed, eternally almost. But they've been a little bit less dovish than the Fed lately, and that differential, the decrease in differential yields, yield differential between different economies, real yields that are being corrected for growth rates. That's one of the main determinants of currency moves against each other. And you can see on this chart, the US dollar had this huge bounce during the crash. That was pure and simple. People hiding in the dollar, people freaked out. They jumped into treasuries. A lot of people thought we might see this move big to the upside, and it looked like it might for a while. But ever since that period, we've seen an almost constant decline. It's actually quite impressive to me how much the dollar's come off. But this is negative yields. This is people getting out of the bond market. There hasn't been much foreign buying at all of U.S. treasuries. Almost all of their treasury issuance has been domestic. And all of those things mean less dollar demand. So the dollar's easing off. Like I said, I think negative yields are the bigger thing, but obviously a lot of people watch the U.S. dollar. A lot of people trade commodities against the U.S. dollar. So this is a positive for gold, but it's a positive for all commodities actually, because they all trade in US dollars. So a falling US dollar helps everything really in the commodity space. Just for shits and giggles, frankly, I'm throwing up the TSX Venture chart here for this is a 5-year. Now, as I think you all realize, certainly anybody gets a newsletter knows, I don't take this index seriously at all. It's essentially a piece of crap, to be quite honest. And it's not a particularly good resource index anymore anyway, because there's so much crypto and weed and whatever in it that it's really not that good at. It's really not that good a measure of resource stocks anyway. But it is a decent measure if you don't take it too seriously numerically of overall sentiment in the space, because let's face it, this is where a lot of the juniors are. It had a pretty impressive dumpster dive here in April. This was an all-time low for the index. It had never been that low before. Thankfully, we've seen about 100% move since then. It's consolidating right now, but again, I'm expecting a pretty good move in this index and all the stocks that make it up from September through December as companies start reporting, metal prices stay good. I think we see, I think we probably see a new 5-year high. I'd be fairly surprised if we don't see this index get through 900 by end of October into November, which is a pretty good move from here in a short period. One of the reasons why it's consolidating now, and this is something to keep in mind going forward. It's not something I'm overly concerned about, because essentially what we're going to be seeing, particularly starting, say, late this month through to January, really, is you'll be seeing the 4-month hold period come off placements. The list that I'm showing you here, this is a TSX Venture total financings monthly this year. You can see that it started off fairly good, not fantastic, but good. Then, of course, dropped off and fell apart as we went into the crash, got down to 143 million total financings, which is a very low total for the month. But ever since then, we've seen it climbing pretty rapidly. It's gone from 143 to over $1 billion last month. I won't be too surprised if we even exceed that number this month. So basically, the monthly total went up 600% from April to August. And again, I think with the generalist money just starting to come in, it'll probably be a little more top heavy, where it's going to be the bigger, more advanced companies doing the big financings. But I won't be surprised if we see the August total exceeded a couple of times in the next 3 or 4 months. But as those 4-month holds come off, there will have to be basically some distribution, some digestion as people take profits, which you should do. If you were lucky enough to get into those March, April, May financings and you're sitting on stuff that's up 400 or 500%, you'd be crazy not to take some money off the table. And that's what I think people are going to do. But again, with the amount of results we're seeing and the amount of money that's starting to flow into the sector, I'm not that worried about it. You'll see dips in some stocks, but unless somebody essentially puts up bad results or something else goes sideways, I don't think you should view these as being a reason to avoid a particular stock for the next 3 or 4 months. Really, the seasonality and the results are going to dominate the pricing. This is just a little bit extra headwind that they're going to have to deal with. But I don't think it's important, but it is something to remember. And you should check individual stocks, because there are a few that did really big, really cheap financings. Those ones will see a lot of selling pressure. They will need to generate news that'll turn that around. Otherwise, they're going to go sideways for a while. Base metals, I got to say, have done better than I expected. A lot of this, I think you can thank China for. If you look at copper, for instance, Chinese demand has been extremely strong this year. I'm honestly shocked how strong it is. China has bounced back. China is doing a lot of infrastructure spending. That's their common way out of this kind of economic mess. They were really the ones that turned the base metal market around single-handedly, really. After 2007, 2008, it was the Chinese period that generated the base metal and metals rally we saw 2010, 2011. They seem to be doing it again. This is also being helped by the fact that there have been a lot of COVID slowdowns. They aren't necessarily complete shutdowns, but a lot of There are a lot of mines that are practicing social distancing. They're putting up production rates that are 20-30% down. And that combination, you've seen a really big drop in warehouse stocks for copper. You've seen big drops for a lot of the other metals as well. Copper is a standout, but all of the base metals have actually done quite well. And of course, that's another tailwind for the resource sector, especially for the base metal guys, most of whom are actually trading a lot better, a lot more quickly than I expected. And of course, a couple of them will be speaking to you here in a couple of minutes. So just to sum up very quickly, September, January, historically, that's the best period for resource stocks during a bull market, which we're definitely in right now. I think this is going to be better than most years because there's so many tailwinds. The only danger is just, maybe we see a bigger shakeout on Wall Street. I think some more shakeout is actually good, but obviously we don't want to see a big crash. That doesn't help anybody, but I don't think that's likely just because of where we're in the election cycle. This basically the U.S. is saying they're going to have negative rates for years and years to come. I mean, they're flat out saying that now. I think they're going to do yield curve control. I don't think they'll admit to that, but I think they're going to do it. Yield curve control, among other things, basically means endless QE because that's how they keep the yield curve pushed down. They just keep generating liquidity and selling it into the market to push the rates down. Base metals, they look good too. So, essentially it's all steam ahead, all pistons firing as far as the resource stocks go. One thing that I do, I will remind you of is that bull markets don't remove expiration risk. So, I mean, obviously a lot of these stocks are trading great. It's fantastic. You're up a lot. This kind of a bull market, I think as time goes on, you're going to see more and more anticipatory buying of companies that are drilling. You're going to see bigger moves just on companies announcing they're going to be drilling or doing anything for that matter. Don't forget to trade these things. These are not widow and orphan stocks, and I don't think there's any such thing as a widow and orphan stock. But when the market gives you 2 or 3 or 400% ahead of results, take some money off the table. The whole idea is to be the smart money here. And the other thing is, since I've been dealing with seasonality so much, don't forget there is individual stock seasonality. There are a lot of Northern Explorers, Golden Triangle Explorers, for instance, that they'll be putting out results into January, but then they're going to be quiet for 5 or 6 months. Most areas do have expiration seasons. So, don't forget that an individual stock will have its seasonality. And if it's one where they really can't do anything for several months, like on a mountaintop in the Golden Triangle, that seasonality is going to probably override the backdrop seasonality of the market. So, don't take the seasonality as gospel, but I think we're all going to have a pretty good time here for the next 3 or 4 months.